Let's continue to discuss cycles in economic data series. So I recently started to have more focus on cycles in the business, Main Street, and cycles within the financial sector, Wall Street. So therefore it makes sense to pay attention to different cyclic forces, also analyzing economic indices, giving us a clue on the financial, Wall Street, and business economic data series. Today, I will revisit the price to earnings ratio, which I did a year ago, but it's quite interesting. So let's check if there is a cyclic pattern in the price to earnings ratio of the US stock markets, right? So we need to talk.
From the mind of Lars von Tienen, the most advanced cycle analysis.
Here we are. Welcome
the
to a
press.
new episode of Cycles TV. If you're new to this series, every week, same place, same time, we meet here to discuss cycle analysis. That's the main purpose. And we use financial business data series for the real analysis to educate ourselves, to learn something, and to discuss how to apply cyclic time cycle analysis to those kinds of data sets. That's why we are here. Thanks for joining. I'm live again. So Lean, Dale, thanks for joining and being on time. I value that. Thanks really for being here with me. And latest at the end, I will pay attention to your questions. So price to earnings ratio. I mean, it's no surprise that the US stock market is highly overvalued. That per se is no news at all. We all are aware of that. So what would be the cyclic perspective on the price to earnings ratio? So the value of price related to the earnings to that stock. So where are we in terms of that measurement? I mean, this is a basic measurement to judge if a stock, so the financial conditions are overvalued or undervalued related to their expected business performance in regards to the earnings. And I mean, it's always interesting to see if we can find some cyclic patterns in these data series, right? So let's start right away. Here we have the Shiller price earnings ratio. So it's a long-term perspective. This is a monthly data series. And we are looking here at a data series going back into 1900 up to today. So we have the latest value from October just right now. So we have 120 years of price to earnings ratio for the Shiller price earnings ratio. So it's a long-term perspective adjusted based on the previous 10 years of earnings of those S&P 500 companies. So that's the data series we're looking at. So don't expect any short-term news on that. But I mean, let's first have a look at the raw data series. So we're looking now at over 100 years of the price to earnings ratio. And we are today sitting here at that level. So that's quite interesting because it's the second highest reading we have. I mean, since we monitor that data, since the past over 100 years. The only point in time when there has been a higher price to earnings ratio has been the internet bubble in the year of 2000, at this point in time. So, and we are now sitting at the second highest absolute reading. I mean, we know per se that absolute reading is no news. So we are all aware of that we have a highly valued stock market out there. But it's the second highest rating if we use the price to earnings ratio, and taking into account that the market is very skewed to the AI topics these days, we all should be very, very careful these days. But I don't want to go into that discussion right now. So let's dig into the data. That's why we're here. And let's start some cycle analysis. Maybe you remember or have been with me around a year ago when I visited the data set. You can also look it back. But for those you are new, if you are new to that kind of data series, let's see now to see what cycles tell us here in that sense. So therefore, let's run a full cycle analysis on that long-term data series. So that's what we see now here at the bottom. As always, if we do a very long-term historical data view, there are much more cycles which show up in the spectrum. So in that case, we are using the full series. However, it's just 1,500 bars. So in terms of data, I think that's okay. But however, we are using 125 years of historical data. So, but have a look at the spectrum here. So a lot of cycles or a lot of peaks in the spectrum showing up. And we need, and we have now embedded this in our platform, we need that information about the so-called stability score. So we only want to use time cycles which have a very high stability or which have a very low variability in terms of how the cycle performed in the past. Yeah? So we want to understand, based on a lot of options we would have to pick some cycles in the data series, what is the most stable cycle in terms of not jumping around, in terms of length and in terms of phase shifts. So often cycles come and go in that sense, or are more dominant or are less dominant, or varying their length and phase very frequently, which is the nature of dynamic cycles. So not blaming cycles for that case, but those cycles are not really useful to do any projection, because we cannot project the variability of that cycle. So we are always using the static situation we measure to do a projection. So therefore, we are looking for those kind of cycles in the past which we can measure. That's one thing. We can measure and detect those cycles based on their length and phase. But I mean, we want to have the best possible stability of a projection area. And therefore, we have for sure the need to identify those cycles which have the lowest variability in the past, because it makes the most sense to use those kind of cycles if they are dominant, if they are there, to use those then for projection. Because if the phase and the length has not really changed much in the past, we could be kind of sure that also now looking into the future, the phase, so the state of that cycle where we are, and the length of that cycle would also not now start abruptly to change. Yeah, that's the kind of stability. So that's not, or that's why the spectrum is not everything. And that's why the knowledge about which cycle to peak, which cycle to pick. The peak in the spectrum is a cycle, and you need then to decide which cycle to pick to do a projection. This information is not in the spectrum per se, so that's why that stability ranking is important. So you can do different visual checks on that. There are different other methods on that, but that's why I always refer to that stability score. And in general, we need to have it above a threshold. And here we only have 2 cycles which fulfill those criteria. Yeah? So they are now the first top 2 cycles here. So 350 months, I mean, that's a very, very, very long-term cycle. So I think that's at least too much I would like to use. But now have a look at the second cycle from its length and its stability. So this is, and let this sink in for a moment, 42 months has a high stability over the past 120 years. Not days. We're talking about a stability score over 100 years and a length of 42 months here. So with the highest strength. Yeah. So this is what really comes out of that data set, which was not expected to see it that way. The 42-41 month cycle is the 180 something week cycle, and that's the cycle Dewey wrote about already in 1920, 1930. So that cycle, to be honest, is not new. It was already detected and talked about in the 1920s, 1930s. So now 100 years later, so we are measuring here from 19 something now to 2025. So 125 years later, that cycle shows up at the top of that list with the highest strength and the highest stability 120 years later. So, that's one, just looking at data and knowing about business cycles and the work of Dewey. That cycle proved to be one of the stablest cycles for the past 120 years and was already documented by Dewey. So, that's just one thing to talk about, right? All right. So all the other cycles, let's go down the list here, you can identify would not fulfill the criteria of being stable enough to use them for any valid projection. Because could be interesting, could not be interesting, but nobody knows. And if they change phase and length again, looking into the future, I think it's not useful for any kind of projection, even if it shows up in the pure spectrum here. So we are almost left with one cycle. 350 months is really too much, too long to really use. I can put that in a second, but let's stick for the most important cycle here. So again, the 42-month cycle, back and forth, documented also in the price to earnings ratio. We find that cycle everywhere, and not skewed so much, but anyhow. So by the way, as I was talking here so long now, has anyone realized another very outstanding characteristic of that cycle scan, which I don't see that often? Not sure if someone watching right now in parallel is observing that already. It's right in front of your eyes. Just look at the picture here. It's outstanding. It's outstanding what you see here. It's not obvious. It's not normal. You don't see that kind of spectrum. Yeah, then all red. Thanks for mentioning that. And again, we talked about a year ago on that, but it did not change on that. So here, have a look here. That shows you the length of that individual cycle, which shows up here as a peak. Yeah, so here's the 42 peak, which is, by the way, so shown here. So it fulfills all criteria we want to have. But besides the length, the color coding of those cycles, yes, Barry, exactly right what you're picking up here, are in their downswing phase. Yeah, so it would not matter which cycle to peak at the current point in time. So the current point in time is October 2025. The 276-month cycle pointing down. the 144-month cycle pointing down, the 104-month cycle pointing down, the 350-month cycle pointing down, the 77-month cycle, the current point of time, pointing down, right? So we could pick any of those cycles, any cycles. Each cycle at the current point in time is pointing downward. There's no single isolated cycle which could give us a clue that the price to earnings ratio will increase further. They're all pointing down. And that's the really, really exceptional observation on that spectrum. I've never seen that kind of. All cycles are in the same phase. So that's the second observation, and it has not changed. And I mean, if you would zoom in, we talked about that here exactly at that point, end of November. Yeah, and we all saw the correction into April then. So we now climbed up the price to earnings ratio again into a higher reading, the second highest reading here. We crossed even the extreme valuations by end of 2024 now. We are now back up here. But there's no cycle which really could explain or could support any continuation of that price to earnings ratio. I mean, we have global liquidity and all those other forces, but this data series, the price to earnings ratio, sitting at the highest level and everything pointing downward. So just the trend might go up, but that's all. All right, so that's the second observation we discussed. So now let's get back to the 41-month cycle, right? So now let's do our basic work. Let's activate that cycle. Let's have a closer look. Let's zoom in and let's see where we are. So it was quite timely as we initially discussed that, and we now really overstretched that leg here. And we're still in that downswing move, which continues to point downwards. So that's the most dominant cycle, yeah, and the most stable cycle, pointing downwards into summer of next year. That has not changed. So, and that's why it's always important to revisit those kinds of series, even though we did this analysis a year ago. Now we have new data points and cycle analysis could change. So it's important to revisit that kind of analysis. But in that case, the cycle is still in the same state and still pointing downwards for the next year to come. So that's, I think, the takeaway here. And let's now continue. So how do we read that data in today's context? So that's a very long-term cycle reflecting business valuation or the financial valuation of those companies in their historic perspective. And yes, even in the valuation of those companies, there is a cyclic pattern, which again is showing us the 42-month cycle, which is the most stable cycle even in the past 120 years of observing that kind of data series. So now we have that knowledge. Again, that cycle has not changed. So let's roll over and plot that cycle on some kind of stock chart series, price series. As we all are aware of, and this is now where more context comes into play, no one can trade time. Maybe if you're dealing with options and construct some option trades here on the duration of different options, but let's keep it a little bit more simple. We cannot trade time. We only can trade price and are paid for price differences we buy or sell or go long or go short. That's based on price, not based on time. So we need to set this into context of price action. That's now next. So, and let me show you different things in a moment. All right, I've just prepared the data. Here. Yeah, here we go. So here we have now an US stock chart, which might look different than the obvious up to today. So including the down move from Friday, I don't think it's not including today's action, but that does not matter. So we're looking now into a more shorter time period, and I'm using here the geometric value index over all US listed stock indices, because it's important that we remove the skew by those, I don't know, 5 to 10 capital weighted AI driven companies, which currently really drive the skewed indices like the S&P 500 or the Nasdaq composite, because they are just those big companies which rate the price action and all the other stocks which are still listed there. So the geometric value line index takes that skew out of the data series and gives you a much more a perspective of the broader market. I mean, we are coming with a long-term price to earnings ratio. So I think we need to remove all skews which could be in the data series, because that skew by just having those 7 high capitalized stocks which influence, I don't know, 60 to 80% of the S&P 500 price index is not really significant if we use that long-term economic analysis. So the geometric value line is more neutral and is reflecting the geometric mean of all US listed companies here. So it's a more broader geometric average of the price action instead of the capital weighted skewed indices here. And by the way, we see that the top of end of 2024 is not exceeded by that data series. So the top we have here and now today, September, October, is not going above the top we've seen in November 2024. And again, it's not the Russell 2000, it's not the Wilshire, it's the geometric mean of all US listed stocks. So that's more the economic perspective in perspective here. All right, so we talk about the price to earnings ratio cycle. So, but before doing that, let's now show what I've done here. Where's that indicator? Come on. Yeah, here we go. So let's scroll in a little bit more data series. So as we have daily here, there's a lot of data. And now I want to show that 42-month cycle. So what you see here, and we are still working with our cycle analysis tool set here. So if you're following that series, what I've just done here is I have just saved that composite. Yeah, so you can save the cycle you have created here, and then you can go to our supercharts section, which I've just done here, load the same data, and I've only loaded the composite of that 42 month cycle, and I've put this as an overlay now on daily price data. So we are using a cycle which has been detected on monthly price to earnings ratio. So that cycle, which is shown here, is coming from the cycle analysis we have executed on the Shiller price to earnings ratio of 120 years of data. And the blue data, which I use here as an overlay, is the rate of change of the value line. So the geometric value line data here. So which makes it easier to see that the rate of change, so the momentum, in the data series matches the cycle and the price to earnings ratio. And this is what I wanted to show you here now. So if we now scroll back in history, you can see that the rate of change of the stock prices here on top of that index matches the ups and downs on the rate of change of prices here. So the cycle is coming from the price to earnings ratio, from the ups and downs in price to earnings ratio. And now going back into history, 2009, here the top, here the top, here the bottoming phase, here forming a bottom, down, up, down again. So, and we can scroll down, or we could scroll back now into the year of 1900, and you always see how nicely those tops here, those bottoms here, the bottom here, 1988, the topping period here, the topping period 1975, bottoming here 1974, and now going back into the bottom of 1970s, and here the top in the rate of change, even dated in 1968. So what we're seeing here, and that's, I think, what you should spot now. So we are using a real long-term cycle detected on the price to earnings ratio. So the ups and downs of highly overvalued price to earnings ratio, and then the down of low valuations. So there is cyclic behavior, long-term cycle, overlaid on daily price data using more neutral geometric average value line of all US stocks. You can identify that this cycle not only has been detected by the price to earnings ratio. Again, we cannot trade the price to earnings ratio. We cannot trade the 42-month cycle. Oh, that's interesting here. Okay, I need to rebuild that. So, but that was just live. Let's do that again. So, if you want to create this on your, so that's a great netting session. We need to rebuild that cycle completely from scratch. So we use the data set, which is the value line. Here it is. That's the value line data. Here we go. Here we have the data back up and running. So now we want to create that rate of change. So let's create standard rate of change. We have here, let's adjust the length. I mean 9. You know that we use cyclic tuned indicators by the way. So this is also a good learning session. Now, how do we change the rate of change here to get some reading? We know that 42 weeks is the most dominant cycle. So we're dealing with daily data here. So a week has 5 trading days, multiply 42 by 5, and you arrive roughly, let's say, 110. That's around half of that dominant cycle length, as you always knew, to fine-tune those indicators here. So here we have the rate of change. Now we want to overlay that with the composite cycle we have saved. So we want to put in a composite cycle, which we just saved, which always starts with CC, and the data here is PE3. That's my data, and I want to have it in a new pane. Here we go again. So now we have the cycle, we have the rate of change. Now I will put the composite on the pane on top, and here we are again. So even if something crashes, we are up and running again. So hope that's a quick learning session if you need to rebuild that on your own. All right. So let's even go back. Yeah, here we are. So the top here. So and that's the beauty. So that's now a static cycle. But let's now move to today's price action. That's where we wanted to continue. So that cycle, we see it here, is now really approaching or still goes into 2026 to approach its bottom. So now we need to see or we expect that the rate of change also will come down furthermore. So that's now, we are now on the daily chart. So now let's zoom in, because cycles give us a clue how to fine-tune technical indicators. And as said, that's now the how to use the information on timing dealing with price information. So I will not jump onto that analysis, but we have now a long-term cycle. We have put it on our price chart now. We also are aware of that there's a weekly and daily active cycle in the US stock markets right now, which is around 180 to 200 days. I will not show you the spectrum and the specific days, but to fine-tune now our technical indicators, it doesn't matter which phase and state that cycle has. We just need to know the length of cycles acting on a daily level, because once we understand the rhythm, independent of the cyclic state, that rhythm helps us to fine-tune technical indicators. And that's, I think, another important takeaway here. If you want to use cycles in a trading environment, time cycles are setting the frame in which price operates. So, and that's always, you cannot trade a pure single time cycle. But the time cycle on the weekly, monthly, weekly, daily perspective sets the frame, the rhythm in which price operates. So you maybe won't see the price specifically following that cycle. That's why you cannot spot time cycles by just looking at the price. But once you know the most dominant length of a cycle, you know that price has a kind of time frame in which price operates. Using that information then, because you trade price, not time, so you need to fine-tune your technical analysis on price based on that timing information. And that's how to deal with parameters, technical analysis based on price information, tuned to the time, to the frame price operates in. And then we can measure the price action specific to the frame of the time cycles. That's a very important concept, and that is the most important fact if you want to put time-based cycles into some kind of trading action on the price chart. I often repeat that but let's do the same procedure again based on the knowledge we have seen here. So therefore, I will again switch now to, I will use the same data we have seen here. Yeah, so we know about the long-term cycle and what to expect. And by the way, this is also the beauty here. So the real peak, or the most dominant peak, is in alignment. We can even put this to the upper pane here. So if you see that overlaid here, we had the first peak here at the 2021, then we came down, and then we had the second peak here end of November 2024. That's the first time when I reported on that. We have seen the red sea of cycles. We have come down, we have come up, but again, we have not exceeded that top here, looking at almost all stocks here, which is a confirmation that this cycle could still be in play which is now pointing downwards. Now let's look into the daily analysis. You can chart that data. So here's the value line geometric index, which is available on almost every charting platform. And let's put in now, and that's what I said with optimized technical indicators. This is the relative strength index. I'm using that here to fine-tune possible price-based actions. And the shading of that indicator is based on the longer-term weekly cycle. As I mentioned, you need to know the weekly dominant cycle, which indicates period of overbought, oversold on the RSI mentioned by the color coding. Yeah, so green means the weekly dominant cycle is in an oversold condition, while light red shaded areas means the weekly dominant cycle based price action is in an overbought condition. And then the signal line is fine-tuned based on the daily dominant cycle. And the signal line with the dynamic bands now shows us when the price action is overvalued on the daily dominant cycle and the other way around. And what we're looking for is the alignment of when the weekly dominant cycle is coming into a price action where we would state now the weekly cycle confirms that price is overbought, which is the red indication. And if in that window we see the same happening on the daily dominant cycle, shown here by the CRSI indicator, then we even have a much more or better alignment of weekly cycles, daily cycles, coming into alignment now on the price action. Yeah, we are not interested in the static timing. So now price action shows us in that timing framework of the dominant cycle is weekly and daily. And that's a very interesting point here. I've never seen that red area since 2021. So it's now we only have seen possible buy actions here in 2022, then 2023, even here in April. Yeah, it showed us really a possible re-entry. And now for, I think, almost over 2 years, it's the first time now the weekly dominant cycle price action indicates we are back in that state, confirmed by the daily cycle. And now, I mean, I don't need to overlay that with the monthly cycle. You know, the monthly cycle is also pointing down. So we have the weekly price action based on the dominant cycle, the daily price action based on the dominant cycle, and the monthly price action based on the price to earnings ratio cycle, all pointing down. And I mean, that's even not the full story here. You see divergences showing up here between price and the relative strength, but that's even not everything. I use a cyclic optimized momentum indicator, but the message I want to show you here on that indicator, you really see when you have a divergence between momentum and price, which is in play since for 3 months now. So really momentum is not keeping up to pace as price action is indicating, so which is another confirmation that we are really due something might happen here. But that's it. That's mainly it. I wanted to come from long-term analysis of economic data series, which is the price to earnings ratio. I just repeated there's on its own a lot of really fascinating data just analyzing the price to earnings ratio. You see the 42-month cycles, you see the red sea of all cycles pointing down in that. Last year I called this the cliff. Yeah, so you can only go really down from that price to earnings ratio, at least if the cyclic condition repeats. And I show you now every time how to use that time-based information to drill it down, nail it down into weekly conditions, daily conditions, and then transfer that time-based knowledge onto the price action. And if you deal with price action, finally you need some technical indicators to tell you when it's time related to the price action. Because that's then the point you can pull your trigger. As said, this is no recommendation, this is no proposal we're doing here. This is only to explain how to use information regarding time-based cycles, a dominant cyclic pattern in financial or business context, and how to make use of that information on the price chart. I mean, that's the purpose of cycle analysis. That's why we are here every week to look at some data series. And that was the topic for me today, to get back to that economic data series. And let's have a look at that. Yeah, I hope you liked, again, a little bit that transformation and the look at the business cycle, the financial cycle, and how to deal with time, how to deal with price, and how to switch between those two perspectives. Thank you, Lean. Thank you, Barry. Thank you, Dan, for joining the conversation a little bit today. So I see Mahendra, you're also there. Thank you for joining. I don't see much complex questions today, so I would thank everyone for showing up here, even after the live stream. And you know about it. We will meet next week, same place, same time. Otherwise, I would recommend to watch the Cycles TV from my colleagues, Richards and Jake, continuing tomorrow and Wednesday, even to follow on. So, have a safe week and see you again. Bye.